Picture this. You're sitting at your desk, reviewing an investment opportunity overseas. The numbers look almost too good to be true. A booming market, high growth potential, and the promise of returns far higher than what you could expect at home. You're already imagining what it would feel like to tell your friends, "I invested abroad, and it paid off big time." But then, reality strikes. Overnight, the local currency takes a nosedive. A new government regulation suddenly increases your tax burden. A trade dispute shuts down supply chains. And just like that, the dream turns into a nightmare. This is not just theory. It happens every single year to thousands of investors who underestimate one crucial element: risk analysis. Today, we are going to break down how you can use risk analysis to not only protect yourself from financial disaster, but also uncover hidden opportunities in overseas markets that most people are too afraid to touch. And by the end, you'll see why mastering this single skill can change the way you invest forever. Let's be honest, international investing has an almost romantic allure. It's about tapping into emerging economies, finding undervalued companies, or being part of global innovation before the rest of the world catches on. But behind that excitement lies uncertainty. And here's the truth: wealth isn't built by avoiding risk. It's built by understanding and managing it. The difference between an investor who thrives abroad and one who loses everything often comes down to a single habit: the discipline of analyzing risks before making a move. Think of it like flying an airplane. Would you board a plane if the pilot said, "We didn't check the weather, but let's hope it's sunny"? Of course not. Yet that's exactly how many investors approach foreign opportunities. If you're here today watching Investor School, it's because you don't want to gamble with your future. You want clarity, structure, and confidence. And that's what we're going to build together. So, what exactly should you be analyzing when you look at an overseas operation? Let's break it down into 4 critical pillars. Political risk. Governments matter. Elections, leadership changes, or sudden policy shifts can completely reshape an industry overnight. Imagine you invest in an energy company abroad, only for the new government to nationalize the sector. Investors who ignored political risk in Venezuela learned this lesson the hard way. Currency risk. This one catches beginners off guard. You may earn 15% in local currency, but if that currency falls 20% against the US dollar, you didn't gain, you lost. Currencies are living, breathing reflections of a nation's stability, and ignoring them is like ignoring the tide when you're sailing. Regulatory risk. On paper, the numbers might look flawless, but hidden beneath them could be tax structures, import restrictions, or compliance costs that erode your profits. It's not just about what you earn, it's about what you keep. Operational risk. Think logistics, labor laws, infrastructure, even cultural differences. A brilliant business idea can collapse in a foreign market if operations can't run smoothly. Remember, efficiency at home doesn't automatically translate abroad. These 4 risks don't just exist to scare you. They exist to be mapped, measured, and mastered. Before we dive into exactly how to turn this risk analysis into your secret advantage, let me pause for just a moment. If you're enjoying this breakdown, make sure you subscribe to Investor School. We publish videos that reveal strategies most investors completely overlook, and I promise you, the next lessons will change the way you see global markets. Now let's flip the perspective. Risk doesn't have to be the enemy. In fact, risk is where opportunity hides. So how do you benefit from it? Step 1, map the landscape. For every country or deal you consider, rate each risk by likelihood and impact. Low, medium, or high probability. Minor, moderate, or catastrophic impact. This simple exercise forces you to see clearly what most people ignore. Step 2. Hedge intelligently. Currency volatility? Don't just cross your fingers. Use hedging tools like forward contracts or options. Large corporations do this all the time, and you, as an investor, can too. Step 3. Diversify across borders. Never put all your chips on one country. Spread your exposure. If Asia slows down, maybe Latin America grows. A balanced portfolio is like a shock absorber for your wealth. Step 4. Build local partnerships. A strong local partner is worth gold. They know the culture, the bureaucracy, and the hidden shortcuts. They can help you avoid costly mistakes and give you an edge outsiders simply don't have. Step 5. Embrace asymmetry. Here's the real magic. Risk analysis isn't just defensive. It helps you spot places where the upside is far greater than the downside. When everyone else runs from risky markets, disciplined investors who understand the numbers can walk in with confidence. Let me give you a story that proves this point. During the European debt crisis, the headlines were terrifying. Greece was collapsing. Investors fled. The media screamed disaster. But a few investors took a different path. They didn't follow fear. They followed analysis. They listed the risks: political instability, heavy debt, weak economy. Then they calculated their exposure, prepared hedges, and looked for undervalued opportunities. And what did they see? Reforms coming, privatization of state assets, distressed properties selling at fractions of their real value. By entering carefully, with risk mapped and managed, they positioned themselves to multiply their returns within a few years. Not because they ignored danger, but because they understood it better than anyone else. That's what risk analysis gives you: the power to turn uncertainty into clarity and fear into profit. Here is the truth you should never forget. Investing abroad isn't a gamble when you prepare. Political, currency, regulatory, and operational risks are real, but they're not roadblocks. They're signposts. The investors who win big in international markets are not those who avoid risk. They're the ones who study it, quantify it, and transform it into strategy. So I'll leave you with this question. If you could invest abroad knowing your risks were mapped, controlled, and even working in your favor, where would you go first? Because that's what separates amateurs from professionals. And that's how you move from being a local investor to being a truly global one.